Tom Lee just said this about markets.
Hi, everybody, and happy Friday. I am Brian Sullivan. All that and more coming up across the hour. But first up on Last Call, a question. Are global elections quickly becoming the top risk for the market and your money? Here's why we say that. Today, French stocks posted their worst week in 2 years. All their gains this year, gone. Investors getting spooked by the possibility of France's far-right party winning upcoming parliamentary elections. Now, that is not the only example. Last week, India's Nifty 50, their Dow, suffering its worst daily decline since the beginning of the pandemic. It's because Prime Minister Modi may lose his majority, but to a more left-leaning party. India's market has since swung back, at least for now, but a similar story last week with Mexico. Its stock market tanking on their election. The Mexican market had its biggest single-day drop in 4 years. And over the past month, nearly every major market in Europe is lower, even as we make record highs. So what does this mean, if anything, as we inch toward the U.S. presidential election in November? Let's talk about that, inflation, and everything else with our friend Tom Lee, FundStrat managing partner and head of research, also a CNBC contributor. Tom, what's that refrain that the cool people on the interwebs like to say, elections have consequences? Well, they certainly have, at least in those markets. Do you see a risk here?
Well, I do think that there is a risk that there is a conservative wave in November. Not that I consider that a risk to markets. I think that unlike Europe, I think that the U.S. stock market is not going to be flummoxed by a change in parties in the White House or in Congress. And one reason for that is, well, one, history just show that regardless of outcomes, equities generally do pretty well post-election. But also, I think that there are maybe sectoral implications for changes in the party, but not for the economy sort of as a whole.
Yeah, that's fascinating. And you wonder if it's because, without diving into politics, Tom, I wouldn't ask you to do that. But let's be clear. From an economic policy perspective, the current guy and the former guy, when it comes to trade and stuff like that, are pretty much the same.
That's right. I'd say when it comes to sort of global trade and sort of global dynamics, they're very similar. I think the differences come with regard to things like energy policy, where I think if Trump, it wins in November, it's actually bad for energy stocks because there'd be more drilling. And I think if Trump wins in November, that it would actually be good for Bitcoin. So in some ways, watching Bitcoin and energy give you some sense for how the market is sort of judging outcomes.
And if Biden wins, it's probably just kind of more of the usual, because we have him in office now and we see what's going on.
That's right. I think that if Biden wins is that you would just have continued gridlock and potentially maybe liberal fiscal spending. And so it's not a terrible dynamic for markets. And as long as inflation doesn't reaccelerate, it doesn't make the Fed's job any harder.
So basically, from Tom Lee's perspective, it doesn't matter who wins the White House this year. Stocks are going to do okay regardless. But I gotta say, Tom Lee is a little contradicting on X. Not in terms of the election or how that could affect our markets, but in terms of the Fed. Tom Lee shared this post on his X account that says, the Fed has to be data dependent because they are mostly wrong when they are not. If Tom is right, then at some point the inflation reports will be plummeting and the Fed will be correctly easing, albeit a few months late. Let me just tell you right now, that would not be good for stocks. If you are a bull in our markets right now, you have to be betting that the Fed is going to be early to cut rates, not late to cut rates. Because if the Fed is late to cutting rates, the party ends. And historically, the S&P 500 drops over 20% upon the first Fed rate cut. And after last week's press conference from Jerome Powell, I am a lot less confident the Fed is actually going to be on time cutting rates. They're going to be far too late. On Friday, you had the University of Michigan's current economic conditions sub-index for the US that fell to 62.5. The expectations by the markets were for 71. So you came in very low, much lower than expected, and you are at the same level of basically pessimistic consumers as you were during the bottom of the '08 Great Financial Crisis. I mean, I don't know what other way to put this, but when the data is reflecting that, eventually it will show up in government data reports and ISM reports and other areas. The question is not really if, but when. And the problem is stocks are not pricing in the if or the when. Markets are pricing in none. No chance of a recession. It's not coming anytime soon, at least over the next 12 to 24 months. And although I think that maybe a recession's a 50% probability over the next 12 months, with markets currently assigning a 0% chance of a recession over the next 12 months, you want to be defensive here. What we actually seen on Friday was a lot of recessionary fears. On Friday, you had the Russell 2000 that was down 1.6%. You had the Nasdaq slightly in the green, bolstered by Nvidia. The S&P and the Dow were slightly in the red also, but take a look at the VIX that was up 6%. Take a look at 10-year Treasury yields that were down over 2 basis points on Friday. Normally, you would expect 10-year Treasury yields, if they were down on any given day, would be a positive for small caps, and indeed it was not. And that's because the markets are becoming more fearful about a potential recession or just overall economic downturn. At least they're getting a little bit worried in small caps, but big tech seems to be immune and actually the safe haven place to be in our markets right now. And there is this presuming narrative that big tech will do just fine regardless of what happens in the economy. And I don't agree with that. I don't agree with shorting small cap stocks arbitrarily because the economy is weakening and buying big tech at all-time highs. That logic to me just doesn't make any sense at all. And it could be setting markets up for a big downside surprise coming over the next few months. I did run this poll on YouTube that says on a scale of 1 to 10, how bearish are you? And I understand I kind of did the poll wrong, but 1 to 2 was like super bearish. 7+ was super bullish. The majority of individuals are mostly bullish between a 5 and a 6. 26% of individuals are 7+, which was super bullish. 3 to 4 is pretty bearish, and that's 23%. And 1 to 2, which is super bearish, is only 11%. Which, being a contrarian by nature, I'm sure we're a little too bullish. But hey, maybe things are going to be fine. That's a possibility. I do think the odds of a recession are higher than 0%. And that's what the markets are currently pricing in. If you look at the S&P index, if you look at the Nasdaq index, they're pricing in a 0% chance of a recession. Now, if you're in big tech names, if you're in the S&P or the Nasdaq, you love that and you've been benefiting from that. All of the capital allocating to the top 10 biggest companies. Eventually, there will be problems in paradise. Eventually, one of two things will happen. Either the Fed will be late to cut rates, which it seems like they will be, and something will break. Maybe that's a negative non-farmers payroll report. Maybe that is the unemployment rate hitting 4.3, 4.4, 4.5%, and the markets go, whoa, wait. Maybe we are going into a recession. That would obviously be bad for stocks, whether the Fed cuts rates or not at that moment in time. Or you are going to get a Fed that engineers a soft landing that cuts rates, and, well, money would likely go back into small cap stocks at that point. So either way, I don't think it's great in any scenario for the headline S&P and the Nasdaq here. And I do think the odds of the Fed making a mistake and waiting too long is probably 90+% at this point. The Fed really caught me off guard last week when they came out and they were super hawkish, or at least super hawkish relative to even the last press conference before last week. I do think the biggest kind of turning point for markets could be Nvidia. Now, let me explain this. Nvidia has had some rock solid stellar earnings. And maybe this quarter is another good quarter for Nvidia, but there are signs that wait times are starting to fall even more for GPUs. And let me tell you right now, if the economy gets worse, if companies are in a worse off position, or there is this overall perception that we are going into recession or could go into a recession, who do you think is going to be hurt the most from that? At this point, Nvidia. Now, let me explain exactly why that is, because companies have been pushing each other down to get their hands on these GPUs, where they're not selling any products. They're not getting a return on investment on their GPUs right now. And they're spending billions and billions of dollars per quarter to buy them. At the first sign of economic problems, what are big companies going to do? They're going to say, we got to preserve EPS. We got to preserve our profitability as much as possible. We have 25, 30,000 GPUs right now. We're not even selling a product using them. We should probably cut down all of this crazy investment. That, I think, will be the true day of reckoning for your big tech stocks. But I have absolutely no idea when that will be. I suspect it's over the next 1 to 3 quarters, but I, again, have no idea. The next big data report that we will get, and of course there will be others as well, but the next big one we will get is on July 5th, the day after the 4th of July, when you will get non-farm payrolls. You're expecting 160,000 job ads currently, and these estimates will change quite a bit before we get to July 5th. And the unemployment rate is expected to stay at 4%. Any further rise in the unemployment rate, I think, is going to spark a lot more fears about the current state of the economy. Non-farm payrolls, that's a difficult one because there's so many conflicting data points that suggest payrolls are not as strong as the BLS report suggests. But I think that will also be important. But the main thing the markets are really going to be watching here, in my opinion, is that unemployment rate. I mean, after all, we added 272,000 jobs last month, and the unemployment rate went up. And another big catalyst coming out next week will be retail sales month over month. For the month of May, you came in at 0%. You're expecting 0.2% positive. So, I mean, if you're at 0%, math's pretty easy on that. Month over month, 0.2%. Well, it's not great because you're coming off of 0%. If you're negative, that could be a bigger problem. And that's pretty much it for major data coming out next week. You do have building permits on Thursday. You have the Bank of England interest rate decision. You're not expecting they are going to cut rates, just hold them steady. Now, coming out the following week, you will have durable goods orders month over month coming out on Thursday, June 27th, and that'll be important as well as the GDP growth rate quarter over quarter, final numbers for Q1. And you're actually expecting this will fall from 3.4% down to 1.3%. Which, if you look at a chart of the GDP growth rate, you're definitely starting to come down from those higher levels that we hit Q3 of 2023 at 4.9%. And compare this to Q1 and Q2 of 2022. If we get some GDP numbers that start to come in even on the weaker side, then yeah, you're going to bring up even larger fears of an economic downturn. So I really don't want to come off as a super hawk, a super bear, because I'm not. I think long term you need to be invested. You have to be invested in our markets. You don't want to bet against the US, but I see the risks as higher than the markets do. Again, the markets are assigning a 0.0% chance of a recession this year, looking at EPS estimates for the rest of this year in 2025, and overall consensus is no recession. I think even if the odds are 50%, that could mean a lot of downside for markets. When we start to get to that point, then investors start to ask, could we go into a recession? Like, that's not even a question being asked right now. And I do think specifically if retail sales coming out next week or durable goods orders coming out the week after that, the week of June 24th, or if the July 5th unemployment rate does go higher or non-farms miss, then the markets will start to ask that difficult question and stocks will be punished. So I don't think there's like an immediate danger of markets crashing on Monday, right? That's not what I'm saying. I'm saying over the next month, 2, 3 months, yeah, there is a greater chance of a downturn, of a crash or a correction than the markets are currently pricing in. And I mean, I'm telling you this as stocks are sitting near all-time highs. Like, I have zero incentive to come out and say this, besides hopefully helping to open up some people's minds to the possibility that markets are not nearly as strong as we think. And as I say this, stocks are technically overbought with an RSI of 73 on the SPY ETF that tracks the S&P 500. And the RSI on the NASDAQ is very overbought, hitting a new all-time high for that index on Friday at 78.64. So let me know what you think about all of this information down below in the comment section. I would love your take on this. Are you bullish? Are you bearish? What are the biggest events that you are going to be watching out for? Are you hedging your portfolio? Are you all in right now? Let me know your thoughts down below in the comment section. You guys have a fantastic rest of your day. If you made it to the end of this video, you learned something, you like my perspective, you like the contrarian nature, the heads up kind of nature of this video, hit the like button and subscribe to the channel. You guys have a fantastic weekend, and I will see you in the next one.